Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Welcome to The Deep Dive, the show that extracts the most important nuggets of knowledge to help you cut through the noise and feel truly well-informed. Have you ever felt that nagging uncertainty about your finances, that desire to build real wealth, but you're just constantly overwhelmed by conflicting advice and, a sea of jargon?
Oh, absolutely. You're definitely not alone there.
We've all been there, I think, wondering if we're actually making the right moves with our money.
It's a completely relatable struggle. I mean, the financial world often bombards us with so much information, and a lot of it feels very prescriptive, maybe even a bit judgmental sometimes.
Yeah, it does.
It leaves you questioning where to even start or which advice genuinely applies to your unique situation.
Exactly. And that's why today we're taking a deep dive into a fantastic resource that promises to simplify all of this. It's Nick Maggiulli's acclaimed book, Just Keep Buying: Proven Ways to Save Money and Build Your Wealth.
Great book. What makes it so powerful, I think, is Maggiulli's unique data-driven approach. He really distills these complex financial ideas into incredibly actionable insights.
He really does. It's earned high praise from financial thinkers like James Clear and Morgan Housel, and, well, for good reason.
And what's fascinating is how he manages to boil down so much wisdom into those three powerful, yet kind of deceptively simple words. Just keep buying.
It sounds almost too simple, right?
It does. But it's a philosophy with a surprisingly personal origin story.
It really is. Maggiulli shares this poignant story of his late grandfather. He was a man who loved gambling, specifically on horse races.
Right.
And despite having a steady retirement income and, minimal expenses, his grandfather died with basically no assets. But Maggiulli, he crunched the numbers, and he found that if his grandfather had simply invested half of his gambling money he was going to spend anyway, right?
Yep, just half.
Just half. Into the U.S. stock market consistently, he would have passed away a millionaire.
Wow. Even through all the ups and downs of the market over those decades.
Exactly. Even through tough market decades, that consistent, repetitive action would have built just incredible wealth.
It's such a stark reminder, isn't it? The power of consistent action over the futility of trying to find the perfect timing.
Totally.
If someone's essentially, throwing money away on gambling, could have accumulated a fortune just through steady investing. Imagine what focused effort could do for you.
And the just keep buying mantra itself, it also has this kind of modern twist. Maggiulli was inspired by the YouTuber Casey Neistat.
Oh, interesting. How so?
Well, Neistat's advice for growing a successful channel was basically just keep uploading.
Okay.
Yeah.
Keep showing up.
Right. And Maggiulli realized this resonated perfectly with his own market analysis. His data showed that it didn't really matter when you bought U.S. stocks.
Like timing the exact low point.
Yeah, forget that. Just that you consistently kept buying them week after week, month after month.
It's a profound insight, really. It cuts through so much of the anxiety around market timing.
It really does.
It shifts the focus squarely onto the enduring power of compounding and just making those consistent contributions.
So our mission today is pretty clear. We're going to unpack Maggiulli's philosophy, challenge some of that, entrenched mainstream financial advice you hear constantly.
Yeah, the stuff that gets repeated over and over.
Exactly. And provide you with evidence-based, actionable takeaways for your wealth-building journey. We want to help you cut through the noise, feel confident in your choices, and get truly well-informed without feeling totally overwhelmed.
Sounds like a plan. We'll explore smart saving, strategic investing, and even dive into the psychology behind our money decisions. It's all connected.
Definitely. Let's begin by grounding ourselves in that just keep buying philosophy. At its core, it's about the continual purchase of a diverse set of income-producing assets. But what exactly does income-producing mean in this context? It's maybe broader than people think.
That's a crucial point. It goes beyond just stocks. When Maggiulli talks about income-producing assets, he's really encompassing things like bonds, real estate, and more. Essentially, any asset you expect to generate value or income for you over the long term.
Even if that income isn't paid out directly, like dividends.
Exactly. Think of it as owning a piece of the world's future economic growth. That growth itself is the value generator.
Okay, that makes sense. And what's truly fascinating, I think, is how accessible this whole strategy is today compared to, say, even just a couple of decades ago.
Oh, it's night and day. It used to be quite a costly endeavor to invest regularly.
Yeah, commissions and things.
Right. Maggiulli highlights that the investment landscape has fundamentally transformed. We now have free trading on pretty much every major platform.
Which is huge.
It's massive. Plus, the widespread availability of fractional share ownership.
Meaning you don't need thousands to buy one share of an expensive stock.
Precisely. You can buy tiny pieces of expensive stocks.
Yeah.
And then there's incredibly cheap diversification through index funds and ETFs.
Right, so you can own the whole market easily.
Yeah, this means you can literally own a slice of the entire U.S. economy or even the global economy for like a trivial sum. This accessibility is a complete game changer for building wealth consistently over the long term.
So with this accessible strategy in mind, a really critical question for all of us is, where should you actually focus your financial energy? Because, time and attention are finite.
Right.
And Maggiulli has this impactful, maybe slightly provocative statement that really makes you think. Saving is for the poor and investing is for the rich.
Yeah, that one definitely grabs your attention.
It does. Now, before anyone gets, offended, let's unpack what he really means here.
It's important. This statement often causes initial misconceptions because we tend to take poor and rich literally in absolute terms.
Right, like specific income levels.
Yeah. But Maggiulli is talking about relative wealth.
Yep.
And crucially, where your efforts yield the greatest impact at different stages of your financial journey. He recounts his own experience as, I think he was a 23-year-old college graduate. He had only about $1,000 in his retirement account.
Which is pretty typical starting out.
Totally typical. But he was obsessing over his investment decisions, spending hours analyzing whether he should have 15% or 20% in bonds.
Oh, I can absolutely relate to that kind of, neurotic optimization. You feel like you should be trying to squeeze out every last 1/10%.
Right. But here's the kicker. At the same time, he was easily blowing $100 on a night out in San Francisco. Yeah. Dinner, drinks, an Uber home.
Okay.
That $100 was effectively an entire year's potential investment returns on his $1,000 portfolio.
Wow. Put that way.
His efforts were completely misdirected. He was focused on optimizing this tiny portfolio while casually spending 10% of it in one night.
That's the real aha moment, isn't it?
It is.
The core insight is that when you have very little invested or you're just starting out, your efforts to save more and add to your principal. That's what will yield far greater returns in building your actual wealth than trying to optimize the investment returns on that small pot of money.
Exactly. Your savings rate swamps your investment return when your balance is low. Conversely, once you have a large portfolio, say several $100,000 or millions, the returns generated from investing your existing wealth will significantly overshadow any new savings you contribute each year.
Right. The growth on the big number becomes a bigger number.
Precisely. At that point, optimizing your investment strategy, your asset allocation, minimizing fees, that becomes far more impactful.
So how can you, listening right now, figure out where you are on this save-invest continuum? Maggiulli provides a pretty simple guide, right?
Yeah, it's very practical. First, calculate your expected savings, what you can comfortably, realistically save in the next year. So if you can save $1,000 a month, that's $12,000 a year.
Okay, easy enough.
Second, determine your expected investment growth in dollar terms. So if you have a $100,000 portfolio and you expect, let's say, a conservative 7% return after inflation, that's $7,000 and expected growth.
Got it. Then you just compare those two numbers.
Simple as that. If your expected savings, $12,000 in our example, are higher than your expected investment growth, $7,000, your primary focus should be on saving more, finding ways to increase that principal contribution.
Okay.
If your expected investment growth is higher, say you have a $500,000 portfolio expecting $35,000 growth, and you save $15,000 a year, then you should spend more time fine-tuning how you invest what you already have.
Because optimizing that larger base has a bigger impact. And if they're close,
Then you dedicate time to both. Makes sense, right?
it does. It's a really clear way to prioritize. And what's truly fascinating is how this focus naturally shifts over a lifetime.
Yeah, Maggiulli illustrates this beautifully with an example. Someone saving $10,000 a year, getting a 5% annual return. In year one, their annual savings contribution, $10,000, is 20 times greater than their investment growth, which is only $500 on the initial $10.
Right. Savings dominate completely.
Completely. But fast forward 30 years. Assuming they kept saving that $10 a year, their portfolio has grown substantially. Now, their investment growth in that year is actually more than 3 times greater than their annual savings contribution.
Wow, that's a powerful illustration. It really drives home that in the early decades, your savings contributions are the primary engine of wealth building.
They absolutely are.
But by the end of a working life, maybe 30 or 40 years in, nearly 70% of your total wealth often comes from those investment gains, not just the money you physically put in.
That's a critical long-term perspective. It dictates where you should apply your precious time and energy at different stages of life. Focusing on tiny investment tweaks when you have $5,000 saved is less useful than figuring out how to save an extra $100 a month.
Absolutely. Okay, let's shift gears now to smarter saving and spending for financial well-being, because let's be honest, a lot of what we think we know about managing our daily money is actually, well, maybe quite flawed.
Yeah, Maggiulli really challenges conventional wisdom here, particularly with his take on the problem with most savings advice and what he calls the biggest lie in personal finance.
Okay, intrigued already. Where does he start?
He starts with this fascinating biological parallel. He talks about desert fish, I think char,
Yeah.
that adapt their bodies to their environment. When food is scarce, they literally shrink their digestive tracts.
Wow, really?
Yeah. And when food is plentiful, like when salmon arrive, they grow them back bigger. He argues our financial physiology, our approach to money, should adapt similarly. Rigid savings advice doesn't work when your income isn't stable or predictable.
That's a great analogy. So applying that, what's specifically wrong with standard advice? Like just save 20% of your income. It sounds so simple and reasonable.
It sounds simple, but Maggiulli argues it rests on 2 fundamentally flawed assumptions. First, it assumes a steady, stable income.
Which isn't reality for many people.
Increasingly not. Data from the Panel Study of Income Dynamics, the PSID, shows incomes are actually less stable over time now. Think about the rise of the gig economy, contract work, or even households with 2 incomes, meaning 2 potential job losses instead of just 1. Volatility has increased.
Okay, that's the first flaw. What's the second?
The second flawed assumption is that everyone can save at the same rate, regardless of their income level.
Right.
But empirical research, real-world data clearly shows this isn't true. He cites studies showing the bottom 20% of earners save only about 1% of their income annually, on average.
Only 1%.
Well, the top 1% save a staggering 51%. It's hugely dependent on income.
Those numbers are stark. It really brings home the reality of spending for lower-income households, doesn't it?
Absolutely. Maggiulli highlights data from the Consumer Expenditure Survey. It showed that in 2019, the bottom 20% of earners spent over 100% of their take-home pay on just 4 necessities: food, healthcare, housing, and transportation.
Over 100%, just on those 4 things.
Yeah. Their average monthly income was around $1,020, but their average spending on just those essentials was $1,947.
So they're already in the red just covering basics.
Exactly. So asking them to cut spending in half or save 20% is it's simply not realistic. There's virtually no wiggle room.
And this leads directly to what Maggiulli famously calls the biggest lie in personal finance. What exactly is that lie, and why does he find it so problematic?
That lie is the pervasive idea, you hear it everywhere, that you can get rich just by cutting small, discretionary expenses. The classic example is your daily $5 coffee.
The latte factor.
The latte factor, exactly. This advice often relies on completely unrealistic investment return assumptions, like assuming a 12% annualized growth year after year, which is well above long-term historical averages.
Right. Or it assumes you can do it for 40 years without fail.
Or it advocates for an extreme frugality that just isn't sustainable or desirable for most people. Maggiulli finds it kind of condescending, frankly. The implication that if you just, made your own dish soap or stopped buying avocado toast, you'd be financially free.
Yeah, it ignores the bigger picture.
It entirely misses the systemic issues and the very real limits to how much someone can cut, especially when they're already spending the vast majority of their income on absolute necessities.
Okay, so if cutting spending has its limits, particularly for those not earning a high income, where should we focus our energy instead?
Maggiulli argues forcefully for focusing on income, not just trimming expenses. And the data supports this. Generally speaking, increases in income aren't followed by similar percentage increases in spending for most households.
Meaning, as you earn more, you don't necessarily spend proportionally more.
Exactly. Higher income households, in aggregate, spend a smaller percentage of their income on necessities. This makes saving inherently easier for them. Think about it. The floor on necessary spending is relatively fixed, but the ceiling on potential income is theoretically much higher.
That makes perfect sense. Cutting spending has a limit. You can only cut so much, but growing income doesn't really have that same hard limit.
Precisely.
So how do we increase our income? That brings us nicely to the concept of human capital. Can you break that down?
Sure. Human capital is essentially the economic value of your skills, your knowledge, your experience, and your time. It's the asset you have that you can convert into financial capital, into money.
Okay. And Maggiulli outlines 5 key methods to do this, right? To boost that conversion.
Yes. First, there's selling your time or expertise, like consulting or freelancing. It's relatively easy to start, but doesn't scale well because you only have so many hours in a day.
Right, trading time for money directly.
Exactly. Second, selling a skill or service, like photography, writing, or graphic design. Here, you can potentially charge more based on the value of the skill, not just the hours, so it's a bit more scalable.
Oh, okay.
Third, teaching people. This could be through online courses, workshops, books. This offers high scalability. You create it once, sell it many times, but it's often a very competitive space.
Makes sense. What's next?
Fourth, selling a product. Think creating an app, writing software, opening an e-commerce store on Shopify. This can scale significantly, but it usually requires upfront investment in time or money, plus marketing effort.
High potential, but higher risk and effort.
Definitely. And finally, fifth, climbing the corporate ladder. This is the most common path for building wealth steadily over time. You gain skills, experience, seniority, hopefully higher pay, often with less direct financial risk than starting your own venture. The data shows most millionaires actually build wealth over decades through professional careers.
That's an important reminder. It's not always about side hustles or startups.
Not at all. But the end goal, regardless of the method you choose, is what Maggiulli calls thinking like an owner.
What does that mean in practice?
It means not just earning more money from your labor, but actively using that income to convert your human capital into financial capital specifically by acquiring those income-producing assets we talked about earlier.
Ah, okay. So using your salary or business income to buy stocks, bonds, real estate.
Exactly. He illustrates this brilliantly with the anecdote of Jerry Richardson. He was the only billionaire to ever play in the NFL.
Wow, really? How did he do it?
Crucially, he didn't get rich from his player salary, which was tiny back then compared to today. He became fabulously wealthy by taking his earnings and opening Hardee's franchises. That business ownership then fueled more investments, and eventually he owned the Carolina Panthers NFL team.
So his labor income fueled his business ownership, which then generated massive wealth.
That's the mindset shift. Use your income, your converted human capital, to buy assets that work for you, generating more income passively. That's how you turn your limited time into lasting assets.
This sounds great in theory, earn more, buy assets, but let's be real, spending money often comes with a lot of guilt and anxiety. Maggiulli tackles this head-on in the section, How to Spend Money Guilt-Free, the 2X Rule, and Maximizing Fulfillment.
Yeah, this is a really helpful part of the book. He opens with 2 fascinating, kind of extreme anecdotes that really resonate.
Tell us about them.
So first there's James, who apparently spent money completely serverlessly, without a second thought. He had no concept of prices because he never had to worry about them. Maggiulli mentions him even trying to charter a helicopter on a whim.
Okay, that's one extreme. What's the other?
The other is Dennis, who was the polar opposite. He became obsessed with gaming Uber's surge pricing system just to save maybe $5 or $10 on a ride. But his complicated scheme backfired spectacularly on New Year's Eve, leaving him stranded and ultimately paying a $264 bill.
Oh, wow. So neither extreme is ideal.
Not at all. James spent recklessly without thought, while Dennis was consumed by anxiety trying to optimize and save tiny amounts, ultimately costing him more.
And most of us probably lean more towards Dennis's anxiety when it comes to spending, right? Especially with mainstream finance advice constantly making us feel guilty.
Absolutely. That advice, like Sue Zorman famously saying buying coffee is like peeing $1 million down the drain, definitely doesn't help. It just creates this constant background hum of guilt around any non-essential spending.
Yeah, it really does.
And it's not just for the average person. Maggiulli points out that even millionaires often worry constantly about running out of money. So we need a better framework, and his first actionable tip is the 2X rule.
Okay, explain the 2X rule. How does it work?
It's brilliantly simple. For every splurge, And he emphasizes that you define what feels like a splurge, whether it's $10 on fancy socks, $1,000 on a new gadget. You have to also invest an equal amount into income-producing assets or donate that same amount to charity.
Ah, I see. So if I spend $200 on concert tickets, I also have to put $200 into my investment account or give $200 to a cause I care about.
Exactly. It's a fantastic psychological hack. Why? Because it removes the guilt. Your indulgence is being balanced by a positive action that builds your future wealth or contributes to something good.
That makes sense. It reframes the splurge.
It does. And it also forces you to really reevaluate how much you truly want something. If you look at that $500 gadget and think, am I also willing to put another $500 towards my retirement for this? If the answer is no, you probably don't want it that badly after all. It introduces a deliberate friction.
I like that. It's practical and addresses the emotion. Beyond the 2x rule, Maggiulli also talks about maximizing fulfillment through our spending choices. He brings in Daniel Pink's framework here.
Yeah, Pink's framework of intrinsic motivation, autonomy, mastery, and purpose. Maggiulli suggests we can use this to spend more consciously and align our spending with what truly brings us satisfaction.
How does that work? Give an example.
Well, think about that daily latte again. Maybe it seems like a frivolous expense based on traditional advice. But if having that coffee at your desk truly helps you focus, feel more productive, and perform better at your job, essentially enhancing your occupational mastery, then maybe it's actually money well spent in the context of your values and goals.
So it's about connecting the spending to a deeper purpose or value for you.
Exactly. The core idea is that money is just a tool. It's a tool to help you create the life you want. But figuring out what that life looks like, what your values are, requires some introspection. It's not just about accumulating more.
And he mentions research supporting this.
Yes, research from Cambridge University found that purchases fitting one's psychological profile, like an introvert buying books or an extrovert buying travel, lead to higher life satisfaction than total income or total spending alone.
That's fascinating. And it challenges some common advice, doesn't it? Like the blanket statement, buy experiences, not things.
It does. Maggiulli points out that advice might be skewed towards extroverts. An introvert might genuinely derive more long-lasting fulfillment from acquiring a high-quality tool for a hobby, mastery, or creating a comfortable home environment, autonomy, than from a crowded concert experience.
So the ultimate takeaway here is
the only truly right way to spend money is the way that works for you, aligns with your values, and brings you genuine fulfillment. Know thyself, basically.
Okay, so we're earning more, we're spending guilt-free, using the 2x rule and focusing on fulfillment. But what about the dreaded lifestyle creep? You know, as your income goes up, your spending goes up to match it. Many experts tell us to avoid this at all costs.
Right, the warnings are everywhere.
But Maggiulli has a surprising, maybe more nuanced take in how much lifestyle creep is okay, more than you think.
He does. He opens with that really compelling cautionary tale of Cornelius Vanderbilt's immense fortune. Vanderbilt died in 1877 with something like $100 million, which would be billions today.
An unbelievable amount of money.
Unbelievable. Yet his descendants managed to squander almost all of it within just 20 years due to the most extreme lifestyle creep imaginable. Stories of dining on horseback indoors, smoking cigarettes rolled in $100 bills. Just absurd extravagance.
Okay, so that's the warning. But Maggiulli then counters the mainstream advice, right?
He does. He basically asks, what's the point of working so hard if you can't enjoy any of the fruits of your labor? He argues that some lifestyle creep is actually okay, even healthy. The key is managing it.
That's a refreshing perspective. But where's the line? How do we find that balance between enjoying today and saving for tomorrow?
He argues that for most people, the sweet spot is around the 50% rule. What this means is that spending more than 50% of your future raises starts to significantly delay your retirement timeline.
Only 50%. Okay. So if I get a $10,000 raise, I should aim to save at least $5,000 of it.
That's the simple rule of thumb. But what's really counterintuitive, and he shows this with a detailed table, is that people with higher initial savings rates actually need to save a larger percentage of their raises than lower savers to maintain their original retirement trajectory.
Wait, why is that? That seems backwards.
It's because a raise represents a much smaller percentage increase in the total income for a high earner saver compared to a lower earner saver. So to maintain their high overall savings rate, they need to capture a larger portion of that new income as savings. For example, someone saving 10% might need to save 36% of a raise, But someone already saving 20% might need to save 48% of that same raise.
Okay, that makes sense mathematically, even if it feels weird. But for most people, that 50% rule is a good guideline.
Yes, because most people fall into that 10-25% savings rate range, where 50% is a pretty effective and easy to remember rule. Half is for you today, and half is for future you in retirement.
And it ties nicely back to the 2x rule as well, right? That sense of balance, spend some, save some.
Precisely. It allows for enjoyment and acknowledges your hard work without completely derailing your long-term financial goals. It provides a clear, practical boundary for managing lifestyle inflation.
All right, let's tackle another potentially controversial topic. Debt. Should you ever go into debt? Not always bad is another one of Maggiulli's chapters that really challenges conventional dogma.
Definitely. Most personal finance gurus preach absolute debt avoidance, especially credit card debt.
Cut up your credit cards.
Exactly. But Maggiulli starts with this interesting analogy from nature, the bet hedging strategy of desert annual plants.
Bet hedging. How does that relate to debt?
Well, these desert plants don't germinate all their seeds at once after a rain. Some seeds remain dormant, essentially waiting for future, potentially better conditions.
Right.
They're hedging their bets against the risk that the current rainfall might be followed by a deadly drought. They sacrifice maximum immediate growth for long-term survival probability.
Okay, interesting analogy. How does he apply it?
He argues that some forms of debt can be seen as a similar form of financial bet hedging. He points to the existence of borrower savers, people who simultaneously hold credit card debt and liquid savings in a bank account.
That sounds completely irrational on the surface. Why on earth would you pay, say, 20% interest on credit card debt if you have cash sitting right there earning next to nothing?
It seems illogical from a pure numbers perspective, but researchers found these borrower savers often did it consciously. They had different perceptions about their future access to credit. Maybe they'd been denied loans before. They willingly sacrificed those short-term interest payments to reduce the perceived long-term risk of not having immediately accessible emergency funds if something went wrong and they couldn't borrow later.
So it's like buying insurance, paying a premium for the psychological comfort and security of having cash on hand, even if it costs more in interest.
Exactly. It's a form of bet hedging. He also shares this fascinating anecdote of a woman named Seema in India. She took out a loan with a staggering 15% monthly interest rate, even though she had savings.
15% a month?
Yeah. Her reasoning was purely behavioral. The high cost and fixed repayment schedule of the loan forced her to pay it back quickly. She knew that if she just drew from her savings, she wouldn't have the same discipline to replenish it. The debt acted as a commitment device, a behavioral crutch.
Wow. That highlights how much psychology plays into financial decisions, doesn't it? It's not always about the math.
Not at all. So, based on these ideas, when should you consider taking on debt? Maggiulli categorizes potentially beneficial debt into two main buckets.
Okay, what are they?
First, debt used to reduce risk. Good examples here include not paying off your low-interest mortgage early, specifically to maintain liquidity for emergencies. Or, taking out a fixed-rate mortgage itself can be seen as reducing risk compared to the fluctuating costs and instability of renting long-term. You lock in a major living cost.
Right, using debt for stability or flexibility. What's the second bucket?
Second, debt used to generate a return greater than the cost to borrow. This is the classic justification for things like student loans, assuming they're used wisely for a degree that significantly increases earning potential.
And the return on a college education statistically is still quite significant, even with rising tuition costs, right?
Absolutely. Studies consistently show a substantial lifetime earnings premium for college graduates, hundreds of thousands of dollars for both men and women, even after controlling for various factors and the time value of money. Maggiulli provides a neat little calculation example for valuing an MBA, showing how to weigh the cost against the expected future income boost. If the return outweighs the interest cost, the debt can be a rational investment in your human capital.
But, and this is a big but, there are significant non-financial costs associated with debt, especially certain types of debt.
Crucially, yes. Maggiulli emphasizes that research consistently links non-mortgage debt, things like credit card debt, payday loans, personal loans, to lower psychological well-being, higher stress levels, increased rates of depression, and even worse physical health outcomes.
So consumer debt really takes a toll beyond just the interest payments.
It really does. Mortgage debt, interestingly, seems to have the least negative impact on well-being, perhaps because it's tied to a tangible, appreciating asset and seen as good debt. But high-interest consumer debt is generally something to avoid if possible, for both financial and mental health reasons.
And some people are just naturally debt averse, right? Even if the math says keeping a mortgage is optimal, they might sleep better paying it off.
Exactly. Personal finance is personal. For some personalities, the peace of mind from being completely debt-free might outweigh the potentially higher financial returns from keeping leverage. Ultimately, Maggiulli concludes that the most fortunate individuals are those who can choose when and how to use debt strategically. Many people, unfortunately, rely on high-cost debt just to survive emergencies, often falling into a difficult, vicious cycle.
That's a really important distinction. Having the choice is key. Okay, let's move into part 3. Strategic investing for long-term wealth. And for many of us, the single biggest financial decision we'll ever make revolves around our home. Maggiulli asks that classic question, should you rent or should you buy? How to think about your biggest financial purchase.
Yeah, this is a huge one, loaded with emotion and societal pressure.
It really resonated with me personally. I was thinking about my grandparents' home. They bought it way back in 1972 for about $28,000. Today, it's probably worth around $600,000.
Wow, that's a massive increase.
It is. That's like a 20x return on paper, maybe 3x adjusted for inflation. But honestly, the number isn't even the main thing. It was the social wealth tied up in it. All the Christmases, the family gatherings, the pencil marks on the doorframe tracking our height. Just the comfort and stability of that fixed place, that felt invaluable.
That emotional appeal is incredibly powerful, and it's often why homeownership is so deeply ingrained as a goal, almost romanticized. But Maggiulli urges us as investors to try and strip away some of that romance and look critically at the true costs involved.
Okay, so let's break down those true costs. What are we talking about beyond the mortgage payment?
Well, first, there are significant one-time costs that people often underestimate. You've got the down payment, obviously, which can be substantial. But then there are closing costs. Things like appraisals, title insurance, legal fees, which typically run 2–5% of the home's value. And if you use real estate agents, their commissions can be another 3–6%.
So even excluding the down payment, just the transaction costs of buying can be a hefty percentage, maybe 2% up to even 11%.
Easily. That makes moving frequently incredibly expensive if you're buying and selling each time. Then there are the ongoing costs.
Right, it doesn't stop with the purchase.
Not at all. You have property taxes, which can be 1–3% of the home's value annually, depending on where you live. Homeowners insurance. If you put down less than 20%, you'll likely have private mortgage insurance, PMI, maybe another 0.51% per year. And then there's maintenance.
The joys of leaky roofs and breaking water heaters.
Exactly. Experts often recommend budgeting 1–2% of the home's value each year for maintenance and repairs. Plus, there's the significant time cost involved in managing contractors, doing DIY work, mowing the lawn. These are all variable risks that homeowners bear, unlike renters who generally have a fixed monthly cost.
Great, that paints a more complete picture of ownership costs. So flipping it, what's the real cost of renting them beyond just the monthly check?
The primary cost or risk of renting is long-term uncertainty. You face unknown, future housing costs. Your rent can go up significantly over time. And you face instability. Your landlord could decide to sell or not renew your lease, forcing you to move, which incurs its own costs and significant mental turmoil. Renters are always subject to the prevailing market price, unlike homeowners who, with a fixed mortgage, lock in a large portion of their housing costs for decades.
So it's a trade-off between higher, more variable costs of ownership versus the uncertainty and potential instability of renting. Given all that, how does housing actually stack up purely as an investment? We always hear it's a great investment.
Well, the historical data is maybe less compelling than many people assume. Maggiulli cites the work of Nobel laureate Robert Shiller, whose data shows that U.S. housing, adjusted for inflation, provided a return of only about 0.6% annually for the century, between 1915 and 2015. It was basically flat for 100 years before the boom leading up to 2000.
Only 0.6% above inflation. That's not great compared to stocks or bonds.
Not at all. And when you factor in the opportunity cost, it looks even less attractive, purely from an investment standpoint. Let's revisit your grandparents' example. That $28,000 home grew to $600K. Impressive. But if they'd rented and invested that initial $28,000, plus the equivalent of their mortgage tax insurance payments, say $280 a month, escalating slightly, into the S&P 500 from 1972 onwards.
I sense where this is going.
They likely would have ended up with well over $1 million. Maybe significantly more, depending on the exact assumptions. Now, emotionally, holding stocks through crashes is much harder than living in a house whose value you don't check daily. But purely financially, housing often underperforms.
So does this mean we should all just give up on the dream and rent forever?
Not necessarily. Maggiulli concludes, buying a home isn't about if, but when. There are powerful societal and personal reasons people buy homes. Homeownership rates are very high among high-income and wealthy households for a reason. Your home determines your neighborhood, potentially your kids' schools, your community, things that have immense non-financial value. Lifelong renters might feel excluded from certain aspects of community or long-term stability. It's often the biggest financial decision people make because it shapes so many other aspects of their lives.
Okay, so it's not just a simple spreadsheet decision. If someone decides ownership is right for them, when is the right time to buy? Maggiulli gives us 3 clear conditions to meet.
Yes, 3 hurdles to clear. First, you should realistically plan to stay in that location for at least 10 years.
Why 10 years?
To allow the home's potential appreciation and the benefits of ownership to hopefully outweigh those significant upfront transaction costs we talked about. If you move sooner, those costs eat away at any gains.
Okay, 10 years minimum. What's second?
Second, you should have a relatively stable personal and professional life, meaning you're less likely to need to move suddenly for a job or quickly upgrade because your family size changes unexpectedly. Again, avoiding future transaction costs.
Makes sense. Stability in life minimizes costly moves. And third,
you can genuinely afford it. This means ideally having a 20% down payment, or at least the clear ability to save one without crippling yourself, and ensuring your total debt-to-income ratio, including the potential mortgage, property taxes, and insurance, stays below the generally accepted threshold of 43%.
affordability, stability, and a long time horizon. And he adds a strategic tip here too, right? About starter homes.
Yeah, this one's interesting. He suggests that because transaction costs are so high, it might be smarter to wait a bit longer and stretch slightly to buy a bigger home that you can stay in for longer, rather than buying a smaller starter home that you know you'll outgrow and need to sell again in just a few years, incurring all those transaction costs twice.
Delay gratification a bit to avoid paying fees twice. That's smart. Okay, so once you've decided to buy, or maybe you're saving for another big purchase like a car or a wedding, Maggiulli gives really practical advice in how to save for a down payment and other big purchases. Your time horizon is key.
Yes, this tackles the "where should I put my savings" question based on when you'll need the money. And he notes that most financial advisors seem to default to one answer for all short to medium-term savings.
Trick is.
Cash, cash, cash. Usually recommending high-yield savings accounts or money market funds.
And is that good advice?
For very short-term savings goals, say anything under 3 years, Maggiulli agrees that cash is generally the best place. Yes, inflation will erode its value slightly. Maybe it takes you 25 months instead of 24 to reach your $24,000 goal. But that's a small price to pay for the certainty that the money will absolutely be there when you need it without risking a market downturn right before your purchase.
Okay, so cash for the short term, under 3 years. But what about for midterm goals, say 3 to 10 years out? A down payment you plan to make in 5 years, for example. Is cash still optimal then?
This is where Maggiulli suggests bonds often become a better choice. Historically, for goals in that 3 to 10 year time frame, bonds have tended to outperform cash, even after accounting for their own price fluctuations.
Why is that? Don't bond prices fluctuate too?
They do, but over a 3 to 10 year period, the slightly higher expected return from bonds often overcomes both inflation and potential short-term price dips more effectively than cash sitting still. For a 5-year goal, his example shows bonds might get you there in 60 months versus 67 months for cash, purely due to inflation drag on cash. The impact of bond price volatility is often less detrimental than sustained inflation over these medium horizons.
Interesting. So cash for under 3 years, bonds for 3 to 10 years. What about long-term savings, 10 years or more?
For very long-term goals like general retirement saving, where the exact end date is flexible, stocks generally offer the best potential returns. His example shows reaching a $60 goal might take 54 months with stocks versus 60 with bonds.
But there's a big caveat here, right? Especially for a fixed, large purchase with a specific date, even if it's 10 plus years away.
A huge caveat. Stocks are volatile. You face the risk of a major market crash, think 1929, 1974, 2000, 2008. A severe crash could significantly extend the timeline needed to reach your specific savings goal, potentially by a year or even longer, right when you need the money. So for a fixed, large purchase like college tuition starting in 12 years, using 100% stocks for that specific pot of money is probably too risky due to that sequence risk near the end date.
So what's the simple rule of thumb to take away?
For specific savings goals, if you need the money in less than 3 years, use cash. or cash equivalents. If you need it in 3 to 10 years, consider using bonds. For very long-term, general investing without a fixed deadline, like retirement decades away, stocks are usually the preferred engine for growth, but maybe not for funding specific, large purchases, even on a 10-plus year timeline if the date is firm. Time horizon is absolutely key.
That's super clear and practical. Okay, this leads us to the ultimate saving question, the big one. When can you retire? More than just money. You mentioned Nobel laureate William Sharpe called retirement planning the nastiest, hardest problem in finance.
He did, and for good reason. There are just so many unknowns. We don't know future investment returns, we don't know future inflation, and most critically, we don't know how long we're going to live. Planning for potentially 30-plus years without an income is incredibly complex.
So where do we even start? A fundamental tool here is the famous 4% rule, right?
Yes, the 4% rule is legendary in financial planning circles. It was developed by financial advisor William Bengen back in 1994.
What did he find?
Bengen analyzed historical market data and found that retirees who withdrew 4% of their initial portfolio value in the first year of retirement and then adjusted that dollar amount upward for inflation each subsequent year had historically never run out of money over any 30-year period, assuming a portfolio of at least 50% stocks, often modeled as 50-50 stocks bonds.
So it provides a safe withdrawal rate,
Right.
and it gives us a way to calculate a target retirement number, doesn't it?
Exactly. The simple calculation derived from the 4% rule is your target retirement savings equal 25 times your desired annual spending. That isn't covered by other guaranteed income sources like pensions or Social Security.
So if you figure you need $40,000 per year from your portfolio to live comfortably, you multiply that by 25.
And you get a target of $1 million saved. It's a very useful benchmark. And interestingly, Bengen himself later argued that in periods of lower expected inflation, the safe withdrawal rate might even be closer to 5%, potentially offsetting the impact of lower expected investment returns today compared to history.
But Maggiulli points out a potential flaw or conservatism in the standard 4% rule application. It usually assumes your spending increases by the rate of inflation, say 3%, every single year in retirement. Does real-world data back that up?
Actually, no. This is a key insight. Multiple studies, including analysis by J.P. Morgan and data from the Consumer Expenditure Survey, show that for most retirees, real spending actually tends to decline gradually throughout retirement, often by about 1% per year on average.
Declines. In which areas typically?
Spending tends to decrease, particularly in categories like apparel, services, entertainment, transportation, and often housing costs drop significantly once a mortgage is paid off. While healthcare costs tend to rise, the decline in other areas often outweighs it for the average retiree.
So what does that mean for retirement planning?
It means the 4% rule, by assuming constantly inflating spending, is likely quite conservative for many people. This might explain the retirement consumption conundrum, the observation that many retirees don't actually spend down their principal and often see their wealth continue to increase throughout retirement. Maggiulli cites data suggesting only about 1 in 7 retirees actually draws down principal significantly.
That's fascinating. So the 4% rule is maybe more of a worst-case scenario than a likely reality for spending patterns. And Maggiulli introduces another, perhaps simpler, metric for financial independence, too.
Yeah, he likes the crossover point rule. It's simply the point in time when your monthly passive income from your investments exceeds your monthly expenses.
Ah, the point where your money makes enough money to cover your bills.
Exactly. The formula to estimate the assets needed for this is crossover assets, monthly expenses, expected monthly investment return, as a decimal. It's a clear, powerful benchmark for reaching financial freedom, even if you don't fully retire in the traditional sense.
But this chapter, crucially, isn't just about the numbers, the dollars and cents. It dives deep into the existential crisis of retirement.
This is where Maggiulli gets really profound, I think. He quotes the author Ernie Zielinski, who argues that physical health, mental engagement, and social connections actually play a much bigger role than financial status in determining happiness and well-being in retirement. Money is necessary, but not sufficient.
He shares some compelling anecdotes here.
Yeah, he does. Kevin O'Leary, Mr. Wonderful from Shark Tank, famously retired super young, around 36, after selling his software company for billions. And he said he was bored out of his mind within months. He went back to work because work provided structure, challenge, identity, and social interaction, things he desperately missed.
A cautionary tale about retiring from something without knowing what you're retiring to.
Precisely. Maggiulli also mentions Julian Shapiro's observation about friends who sold startups for millions. After about a year of travel and relaxing, they almost inevitably got bored and went back to working on old side projects or starting something new. Their lifestyle didn't change dramatically beyond maybe a nicer home and eating out more. They needed purpose.
And he even touches on the FIRE movement, financial independence, retire early.
Yeah, he shares the story of Terrence, a guy who achieved FIRE and became a digital nomad traveling the world. But Terrence eventually found it to be a surprisingly lonely existence. He felt disconnected, like he was no longer relevant or important without the structure and community of work.
Wow. These stories really challenge the common fantasy of early retirement being endless bliss.
They really do.
So the real critical questions for you, the listener, thinking about retirement, go far beyond just the 4% rule or the crossover point. They are, what will you actually retire to? How will you spend those potentially 8, 10 extra hours a day? What will give your life purpose and meaning when work is no longer the central focus?
Money is just the tool that enables the transition. Figuring out what you truly want to do with that time, how you'll stay engaged and connected, that's the really hard and arguably more important part of retirement planning.
Absolutely. Okay, let's transition now into part 4, digging into investing wisdom and the psychology of wealth. Let's start with the absolute fundamental question. Why should you invest? 3 primary reasons. It sounds almost too obvious, but Maggiulli connects it to some pretty deep human truths.
He does. It goes beyond just making more money. The first reason he highlights is tied to the very concept of retirement itself. Retirement, as a distinct phase of life, didn't really exist for most of human history until maybe the late 19th century, with figures like Bismarck in Germany instituting pensions.
Right, lifespans were shorter, people worked until they basically couldn't anymore.
Exactly. Increased lifespans created this new challenge, funding potentially decades of life after our working years end. So, the first reason to invest is simply saving for your future self, a self that previous generations didn't have to plan for in the same way.
And he mentions that psychological trick here too, about visualizing your future self.
Yeah, it's hard for our brains to connect with our distant future self. But studies have shown that looking at age-progressed renderings, basically digitally aged photos of yourself, can actually make that future self feel more real and tangible, which in turn can significantly boost your willingness to save for retirement.
That's a clever mental hack. Okay, saving for future you. What's the second core reason to invest?
The second is preserving your money against inflation. Maggiulli aptly calls inflation an invisible tax that silently erodes the purchasing power of your savings if they're just sitting in cash.
It really does eat away at it over time.
Significantly. He uses the powerful example that from 1926 to 2020, $1 needed to grow to $15 just to maintain the same purchasing power due to inflation.
15 times bigger just to break even in real terms.
Exactly. Now, if you had invested that $1 in relatively safe long-term U.S. Treasury bonds over that period, it would have grown to about $200. If you'd invested it in a broad basket of U.S. stocks, it would have grown to a staggering $10,937.
Wow. That clearly, undeniably shows the power of investing, especially in growth assets like stocks, not just to beat inflation, but to dramatically increase purchasing power over the long run. Cash simply can't do that.
And for retirees who are no longer earning an income, their invested assets and the appreciation on those assets are essentially their only weapon against ongoing inflation eroding their lifestyle.
That's a critical point for retirees. Okay, and the third reason to invest, you mentioned it earlier, but let's revisit it.
Yes, the third, and perhaps the most fundamentally motivating reason, is replacing human capital with financial capital. Remember, your human capital is the present value of all your future potential earnings from working. It's likely your biggest asset when you're young.
Okay.
By investing consistently throughout your working life, you are systematically converting that human capital, your ability to earn income through labor, into financial capital, into assets that generate income for you passively after you eventually stop working.
So you're building a money-making machine to take over when your body's ability or desire to work fades.
Precisely. Maggiulli again highlights the cautionary tale of professional athletes. Many earn millions during a very short peak earning window. Their human capital is immense, but temporary. Those who go bankrupt often fail because they don't convert enough of that temporary high income into lasting financial capital, into income-producing assets quickly enough. Realizing that your own earning power, your human capital, has an expiration date is a powerful motivator to invest diligently while you can.
Definitely puts a fire under you. Okay, so we know why we should invest. Now the big question, What should you invest in beyond just stocks and bonds? This can feel overwhelming. Maggiulli starts with a great analogy from a judo instructor.
Yeah, he quotes Wally J., a renowned judo instructor, who said something like, "The biggest mistake is for an instructor to teach exactly the way he was taught." The implication for investing is clear. There's no single one true path to building wealth. Many different approaches and asset types can lead to success, and what works brilliantly for one person might be a terrible fit for another based on their personality, risk tolerance, time availability, and goals.
So avoid dogma, be open to different strategies. But there are core categories of income-producing assets he outlines, right? Can we briefly list the main ones?
Sure. He provides a good overview. First, stocks, equities. Historically high returns, maybe 8–10% annualized long-term. Relatively low maintenance if you use index funds. But high volatility, you have to expect significant drops, maybe 50% or more, a few times a century. Best accessed via broadly diversified index funds or ETFs for most people.
Okay, stocks, the workhorse for many.
Then bonds, fixed income, lower volatility, maybe 2–4% returns historically. Good for providing stability, preserving capital, and for rebalancing purposes. He emphasizes focusing on high-quality bonds, like U.S. Treasuries, primarily as a diversifying asset for safety, not necessarily for high returns, especially in low-interest environments.
Stocks and bonds, the classic pair. What else?
Real estate, direct investment property, can offer high returns, maybe 12–15% or more, especially when using leverage, a mortgage. But it comes with significant work finding properties, managing tenants, maintenance. It's highly illiquid and carries concentrated risk tied to a single property and location. It's not passive.
Right, much more hands-on.
REITs, real estate investment trusts. These offer exposure to real estate returns, maybe 10–12% historically, but without the direct management headaches. They legally have to pay out 90% of their taxable income as dividends, which can be tax inefficient in regular accounts. He notes the difference between publicly traded REITs, liquid, easy to buy, sell, and non-traded or private REITs, often higher fees, less transparency, illiquid.
A more passive way to get real estate exposure.
Farmland. Historically offered decent returns, maybe 7–9%, often with lower correlation to traditional stocks and bonds, providing diversification. It's seen as an inflation hedge. Access for individual investors is usually through specialized farmland REITs or crowdsourcing platforms.
Interesting alternative.
Small businesses, private equity your own. Potential for extremely outsized returns, maybe 20–25% or even much higher. But this comes with a huge time commitment, significant risk, and a high failure rate. Not usually a passive side hustle if you expect big results.
High risk, high reward, high effort.
Royalties. Income streams from things like music, books, patents, or mineral rights can offer steady income, potentially 5–20%, often uncorrelated with broader markets, bought via specialized online platforms. Maggiulli introduces the Lindy effect here, the idea that things that have been around longer, like a classic song, are likely to stick around longer, which can help assess the potential longevity of a royalty stream.
Fascinating, owning a piece of intellectual property.
And finally, your own product.
Yeah.
Creating and selling your own digital or physical product. Returns are highly variable, from 0 to potentially huge. Offers full ownership and personal satisfaction, but like a small business, it's very labor-intensive with no guarantee of payoff.
So, quite a diverse menu of income-producing assets beyond just stocks and bonds. He also briefly mentions non-income-producing assets, right, like gold, crypto, art.
Yes. He specifically excludes them from his core list of income-producing assets because their value is based solely on perception or speculation about future price increases, what someone else will pay for it, rather than generating underlying cash flows or yield. He acknowledges a small allocation to these can be okay for fun or diversification, like play money, but the bulk of long-term wealth building should focus on assets that actually generate income or economic value.
That makes sense. So the key takeaway is really that the optimal mix, the optimal asset allocation is the one that works for your timeline, your risk tolerance, your interest level in managing it.
Exactly. Find the path you can stick with consistently.
This brings us to a very specific and often highly debated topic within asset allocation. Why you shouldn't buy individual stocks. Underperforming is the least of your worries. This is bound to ruffle some feathers. Maggiulli starts with a very relatable, maybe painful story about his friend Darren.
Yeah, it's a really vivid cautionary tale from the GameStop mania. His friend Darren invested $30,000 in GME stock when it was soaring, I think around $111 a share.
Okay, right in the thick of it.
He made like $9,000 on paper in literally 15 minutes as it spiked higher. Huge adrenaline rush. But then, just as quickly, it crashed. He ended up selling later for a loss of over $12,000. The story perfectly illustrates the intense emotional roller coaster. The greed, the fear, the stress that comes with picking individual stocks, especially volatile ones.
A costly lesson in emotional investing. So, beyond the emotional toll, what's the core argument Maggiulli makes against individuals picking their own stocks?
He breaks it down into two main arguments: the financial argument and what he considers the more powerful existential argument.
Okay, let's start with the financial argument. Why is picking stocks a losing game financially for most people?
Well, the data is pretty overwhelming. Most individual investors and even most professional active fund managers consistently fail to beat broad market indexes like the S&P 500 over the long term, especially after fees and taxes.
We hear that a lot, the stats on active managers underperforming.
And there's a reason for it. Research shows a kind of Pareto principle in stock returns. A tiny fraction of companies generate the vast majority of the market's overall positive returns. One study found that just 4% of stocks from 1926 to 2016 created all the stock market's excess return above safe treasury bills. Just 5 specific firms accounted for 10% of all wealth creation in that entire period.
Only 4% drive all the gains. Wow.
Yeah, and compounding that difficulty is company mortality. Another study showed 78% of U.S. companies trading since 1950 were dead or delisted by 2009. Half of all public companies disappear within 10 years. So you're essentially trying to pick a few winning needles out of a haystack that's constantly shrinking, and where most of the needles vanish over time.
Yeah, it paints a bleak picture for stock pickers. It makes the solution seem pretty obvious then, doesn't it?
It really does. The logical solution is to just own all the stocks, or at least a huge representative sample, through low-cost index funds or ETFs. That way, you guarantee you capture the returns of those few big winners that drive the market, you diversify away the risk of individual company failure, and you significantly reduce the stress and effort involved.
So that's the financial case for indexing. What's the existential argument? Why does he think that's even more powerful?
This argument focuses on the psychological burden and the sheer difficulty of knowing if you're actually good at stock picking. The feedback loops are incredibly long and noisy. You might buy a stock for reason A and it goes up, but maybe it went up for a completely unrelated reason B. Was your thesis right? Was it just luck? It's almost impossible to definitively assess your own skill over the short or even medium term.
That constant uncertainty must be draining.
He argues it leads to a never-ending state of existential dread. You're constantly questioning your decisions, second-guessing yourself. Did I buy the right thing? Should I sell now? Did I miss out on that other stock? And even genuinely skilled investors face long periods, sometimes years, where they underperform the market. It's inevitable. The question isn't if you'll underperform, but when and for how long.
So underperformance isn't just a financial risk, it's a psychological certainty that's hard to endure.
Exactly. And that's why he says underperforming is the least of your worries. The constant doubt, the stress, the inability to know if you're skilled or just lucky, that's the bigger, more corrosive problem for most people trying to pick stocks.
So what's the final advice for listeners on this?
His advice is pretty clear. Either decide to pick individual stocks purely for fun or intellectual stimulation, using only a small, clearly defined portion of your money that you can afford to lose, like 5–10% max, and commit to rigorously tracking your performance against a relevant benchmark over many years to honestly assess your skill or lack thereof.
Okay, treat it like a hobby with strict limits.
Yes. Or, for the vast majority of your wealth-building portfolio, just stick to low-cost, diversified index funds or ETFs. Accept the market return, minimize your stress, save time, and increase your odds of long-term success.
Makes a lot of sense. Okay, once we decide what to invest in likely broad index funds for most of us, the next critical question is timing. How soon should you invest? Invest now, not later. This chapter seems to contain one core piece of information that really guides all the subsequent decisions.
It absolutely does. And that single most crucial insight is remarkably simple. Most markets go up most of the time. This isn't just an opinion or a hopeful guess. It's a conclusion backed by over a century of historical data across global equity markets. Markets have downturns, yes, but the long-term trend is overwhelmingly upward.
So if markets generally trend up, what does that imply about waiting to invest?
It implies that waiting hurts you. Every day you wait, you keep money on the sidelines, you are likely missing out on potential gains because the market is more likely to go up than down on any given day or over any given period. Waiting probably means buying in at higher prices later. Plus, that uninvested cash is losing purchasing power to inflation while it sits there.
So the best time to invest was yesterday, and the next best time is today.
That's the logical conclusion. Maggiulli uses an almost absurd thought experiment. If you had $1 million to invest for 100 years, would you invest it all now or invest 1% each year for 100 years? The answer is obvious. For maximizing long-term growth, get it invested now.
Okay, that makes intuitive sense for lump sums.
Mm-hmm.
But what about the natural human tendency to wait for a better price? You know, that feeling of, oh, the market seems high, I'll just wait for a dip. Doesn't that make sense sometimes?
It feels logical, and Maggiulli acknowledges why. He shows data that on any given day in the history of the Dow Jones, there's about a 95% chance that the index will close lower sometime in the future. So waiting for a lower price seems almost guaranteed if you wait long enough.
Right, so why not wait?
The problem is you don't know when that lower price will come or how much higher the market might go before it drops back down. That wait for a lower entry point could be days, months, or even years. He gives the example of someone waiting for the Dow to drop after hitting a high in 1997. They would have had to wait 12 years until 2009 to see a lower price, missing out on huge gains in the meantime. Market timing is incredibly difficult, maybe impossible, to do consistently.
Okay, so trying to time the market by waiting is generally a bad idea. What about dollar cost averaging, DCA, investing a fixed amount regularly over time versus investing a lump sum all at once? Buy now or lump sum investing?
This is a common question, especially when people receive an inheritance or bonus. Maggiulli presents compelling historical data comparing lump sum investing, LSI, versus dollar cost averaging, DCA. The finding is consistent across different asset classes and time periods. LSI, investing the lump sum immediately, outperforms DCA roughly 2/3 of the time.
2/3 of the time, investing it all at once is better. Why?
Again, because markets tend to go up. By averaging in, you often end up buying shares at progressively higher prices than if you just bought them all at the beginning. The only times DCA really wins is if you happen to invest a lump sum right at a market peak just before a significant crash, because then you benefit from buying into the falling market. But predicting those peaks is impossible, and major crashes are relatively rare compared to periods of market growth.
What about the psychological comfort of DCA? Investing a large sum at once can feel scary.
That's true, and Maggiulli acknowledges the behavioral benefit. If DCA is the only way you can mentally get yourself to invest a large sum without panicking, then it's better than keeping it in cash forever. But he offers an alternative for risk-averse investors.
Which is?
Instead of dollar cost averaging into a 100% stock portfolio, consider investing the lump sum immediately, buy now, but into a more conservative, balanced portfolio, say 60% stocks and 40% bonds. His analysis suggests this approach often provides similar risk reduction to DCAing into 100% stocks, but potentially offers better long-term returns because all the money is working from day one.
That's a smart compromise. Get the money invested now, but manage the risk through asset allocation rather than timing. What about market valuations? Should we wait if metrics like the KPE ratio seem really high?
He addresses this directly. Even when starting with high valuations, like a high KPE ratio, historical data still shows that lump sum investing generally outperforms dollar cost averaging. Waiting for valuations to come down can mean missing out on substantial gains. He points to the period from 2017 to 2020 when the KPE ratio was persistently high, yet the S&P 500 still gained 65%. Waiting would have been costly.
Okay, so buy now generally wins over average in. What about the ultimate timing fantasy? Perfectly buying the dip.
Ah, yes, the dream scenario. Maggiulli runs a fascinating simulation. He imagines an investor with perfect foresight, an omniscient god who only invests money at the exact market bottoms that occur between all-time highs over a 40-year period.
So perfect dip buying. How does that compare?
The results are stunning. Even this idealized, impossible buy-the-dip strategy still underperforms simple, regular dollar-cost averaging, investing the same amount every month regardless of market level, over 70% of the time.
How is that even possible? Perfect timing loses to just investing regularly.
It's because the perfect dip buyer often has large amounts of cash sitting on the sidelines for long periods, waiting for those infrequent major dips, missing out on all the growth that happens during the market's upward climb between dips. The only scenario where perfect dip buying wins is when the biggest crashes happen very early in the 40-year investment period, allowing that perfectly timed investment to compound for decades.
That completely demolishes the wait for the dip mentality.
It really does. The conclusion is absolutely undeniable and forms the bedrock of the book's philosophy. You should invest as soon and as often as you can. Don't wait. Get your money working for you. Time in the market beats timing the market.
That's a powerful data-driven takeaway. All right, now let's talk about something that can feel uncomfortable but is crucial to understand: why investing depends on luck and how to play your hand. This one might be a tough pill to swallow for people who believe success is all about skill.
It can be, but acknowledging the role of luck is essential for setting realistic expectations and managing risk. Maggiulli isn't saying skill doesn't matter at all, but that the market environment you happen to invest in plays a huge role in your ultimate outcome.
How does he illustrate this?
He shows the incredibly wide variation in historical market returns. For example, depending on which 20-year period you started investing in the S&P 500, your average annualized return could have been anywhere from as low as 1.9% to as high as 13%. That's a massive difference, driven purely by your start and end date's luck.
Same market, vastly different outcomes based on timing luck.
Exactly. And he uses a really striking hypothetical example to drive this home. Imagine investor A, who is highly skilled and beats the market by 5% per year. But they invest during a terrible 20-year period where the market itself only returns 1.9% annually, like 1960, 1980. Now imagine investor B, who is a terrible investor and underperforms the market by 5% per year, but they invest during a fantastic 20-year period where the market returns 13% annually, like 1980, 2000.
Okay, who ends up with more money?
The terrible investor, investor B, who invested during the bull market, ends up with significantly more money than the brilliant investor, investor A, who invested during the bear market, despite the huge difference in skill. It powerfully underscores how much your returns depend on the overall market environment you happen to experience, which is largely a matter of luck.
Wow, that really puts individual skill in perspective relative to the market's tide. And this concept of luck ties directly into sequence of return risk, doesn't it? This is a term I think every pre-retiree or retiree absolutely needs to understand.
It's critical. Sequence of return risk refers to the fact that when you experience good or bad returns matters hugely, especially when you are either adding money consistently, accumulating, or, even more importantly, withdrawing money consistently, decumulating, like in retirement.
How does it work?
When you're accumulating wealth over your working life, poor returns early on, when your portfolio is small, are much less damaging than poor returns later in life, when your portfolio is large. Conversely, great returns later on have a much bigger impact. But the real danger is in retirement. If you experience a significant market downturn right after you retire and start withdrawing money.
You're selling assets at low prices to fund your living expenses.
Exactly. You're locking in losses and depleting your principal much faster than if the downturn happened later in your retirement. A bad sequence of returns early in retirement can devastate even a well-funded plan. Maggiulli illustrates this with two scenarios showing identical average returns over 30 years. But the one with negative returns early in retirement runs out of money much sooner than the one with negative returns late in retirement.
The end is everything, as he puts it, referring to the beginning of retirement being the most critical period for returns.
Precisely. Those first 5–10 years of retirement returns have a disproportionately large impact on whether your money will last.
So if sequence risk is a major threat, especially near or in retirement, and it's driven by luck, are we just powerless? How do we play the hand we're dealt?
We're not powerless. We can't control the market sequence, but we can take steps to mitigate the impact of bad luck. The key strategies include diversifying appropriately. Holding enough lower-risk assets, like high-quality bonds, can cushion the portfolio during stock market downturns, reducing the need to sell stocks low, being flexible with withdrawals. If possible, reducing your withdrawal amount during severe market downturns can make a huge difference in preserving principal. Having other income sources. Considering part-time work in retirement or having other income streams reduces reliance on portfolio withdrawals, especially during bad market periods. For young investors, the best mitigator is simply time. If you're decades from retirement, you have time for your portfolio to recover from downturns. Early volatility is less concerning than late volatility.
Okay, so acknowledge luck, understand sequence risk, and build in buffers and flexibility to handle potential bad sequences. That makes sense. Along with luck, volatility is another concept that often scares investors away. Maggiulli tackles this in Why You Shouldn't Fear Volatility, The Price of Admission. He starts with an absolutely incredible story about Fred Smith, the founder of FedEx.
It's a legendary business story. In the very early days of FedEx, the company was on the brink of bankruptcy. They literally only had $5,000 left and couldn't afford fuel for their planes to make crucial deliveries the following week.
Desperate times. What did Smith do?
He took the company's last $5,000, flew to Las Vegas, and played blackjack over the weekend. Incredibly, he won $27,000, just enough to cover the fuel bill and keep the company alive for another week.
That's unbelievable. Talk about high-stakes risk-taking.
Absolutely insane risk. When his stunned colleagues asked him how he could do that, he apparently replied calmly, "What difference did it make? Without the funds for the fuel companies, we couldn't have flown anyway." His point was, inaction was also a guaranteed failure. Sometimes Maggiulli uses this to illustrate the biggest risk you can take is taking no risk at all.
That's a powerful reframe. So applying that to investing, the cost of playing it too safe, the cost of inaction can be just as damaging in the long run as taking excessive risk, but it's often invisible until much later.
Exactly. People are terrified of market crashes, of volatility, of seeing their portfolio value drop. So they try to avoid it, maybe by staying in cash or trying to time the market. But Maggiulli presents data showing this avoidance often backfires spectacularly.
How so?
Analysis shows that trying to avoid even relatively small drawdowns, say 5% or more, would mean being out of the stock market roughly 90% of the time historically. And doing so would result in having about 90% less money than someone who simply bought and held through those drawdowns. The cost of missing the subsequent recovery on upside is huge.
So trying to sidestep volatility means missing most of the growth. Is there a Goldilocks zone of avoidance, like only trying to avoid the really big crashes?
Theoretically, yes. Maggiulli shows that if you had perfect foresight, could only avoid the major drawdowns, like 15% or more, you could potentially outperform buy and hold. But the key words there are perfect foresight. Nobody can predict those major crashes accurately and consistently. Trying to do so usually leads to missing huge rallies.
So the conclusion is we just have to accept volatility.
We have to. Maggiulli quotes the legendary Charlie Munger, Warren Buffett's partner. If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get. Volatility isn't a sign that something is wrong. It's the normal, expected price of admission you pay for the potential of achieving higher long-term returns from owning growth assets like stocks. You have to endure the bumps to get the long-term benefit.
Endure the bumps. That perfectly leads into the next practical challenge. How to buy during a crisis. Stay calm in a panic. Okay, we know volatility is normal, we know crashes happen, and we know they're usually buying opportunities. But actually doing it when everyone else is panicking is incredibly hard psychologically.
It's one of the hardest things in investing. Maggiulli shares a very powerful personal story from the depths of the March 2020 market crash, when COVID was just starting to shut down the world and markets were plummeting.
What happened?
He was walking to the grocery store, feeling the fear and uncertainty that was everywhere. Markets were in free fall, headlines were terrifying. And amidst this global panic, he saw a man working at the mall, meticulously and calmly arranging a display of flowers at the base of an escalator. Just doing his job, creating something normal and beautiful in the middle of chaos.
Wow.
For Maggiulli, that small, normal moment was a profound anchor. It gave him a sense of perspective and hope, and it inspired his framework for how to think and act during market crises.
So what does the data say about investing after a crash?
The historical data is incredibly encouraging for those brave enough to buy when there's fear. Maggiulli presents analysis showing that when markets have already fallen by 30% or more, the subsequent annualized returns during the recovery phase often exceed 10% per year. The chance of getting low single-digit returns after such a drop is actually quite small.
So after a big drop, future returns tend to be strong. What about after a really big crash, like 50% down?
That's when history suggests you should really back up the truck, as the saying goes. When markets are down 50% or more, the subsequent annualized returns in the following years usually exceed 25%. These moments of maximum pessimism have historically been moments of maximum future opportunity.
Those numbers are compelling. But what about the counterexamples? People always bring up Japan, whose stock market stayed down for decades, or maybe Greece after 2008. Doesn't that negate the buy the crash rule?
It's a valid question, and Maggiulli acknowledges these cases. Some markets do experience prolonged downturns or fail to recover previous highs for very long periods, but he emphasizes the overwhelming historical probability. Most equity markets go up most of the time. Looking at developed markets globally, the probability of actually losing purchasing power over a 30-year period, even if you invested at a peak, is only around 12%.
So while possible, a permanent loss is statistically unlikely in diversified developed markets over long periods.
Especially if you're investing over time through dollar cost averaging, which further reduces the risk of putting all your money in at the absolute worst moment. The odds are strongly in favor of eventual recovery and growth.
The real challenge then is purely psychological, overcoming that intense fear when everyone is panicking.
Absolutely. By the time the dust settles and it feels safe to invest again, the market has often already staged a significant portion of its recovery. You have to act when things feel uncertain, even scary. Maggiulli quotes investment manager Ken Fisher. Fear has a greater grasp on human action than does the impressive weight of historical evidence. This chapter is really a guide for building mental fortitude, for trusting the long-term data, and finding the courage to just keep buying, precisely when your instincts are screaming at you to sell or hide.
Easier said than done, but crucial. Okay, we focused heavily on buying and holding, but eventually the question has to become, when should you sell? Purpose of investing. Selling seems almost harder psychologically than buying, doesn't it?
It often is. Selling triggers a different set of powerful emotions. Fear of missing out, FOMO on potential future gains if you sell too early, and fear of loss or regret if you sell and the price immediately drops, or if you sell a loser and lock in the loss. It's a difficult decision point.
So, when is it acceptable or logical to sell your investments? Maggiulli outlines 3 main legitimate reasons. What's the first one?
The first acceptable reason is rebalancing. This is the process of periodically selling some of your assets that have grown significantly, usually stocks, and buying more of the assets that haven't, usually bonds, to bring your portfolio back to its original target asset allocation. For example, back to 60% stocks, 40% bonds.
And the purpose of rebalancing isn't necessarily to increase returns, right?
Correct. Maggiulli emphasizes that rebalancing is primarily for risk control, not return enhancement. In fact, most of the time, rebalancing will slightly lower your total returns because you are systematically selling your higher growth assets, stocks, to buy lower growth assets, bonds.
So why do it?
You do it to prevent your portfolio's risk level from drifting unexpectedly high. If you start with a 60-40 portfolio and stocks have a huge run, you might end up being 80-20 or even 90-10 stocks without realizing it. Rebalancing forces you back to your intended risk level, preventing you from being dangerously overexposed when the next market downturn inevitably arrives. He recommends annual rebalancing for simplicity, often aligning with tax season.
Okay, rebalancing for risk control. What's the second valid reason to sell?
The second reason is getting out of a concentrated or losing position. This scenario often arises for people who receive significant amounts of stock in their own company as part of their compensation, like stock options or grants. They can end up with a huge, risky percentage of their net worth tied up in a single company's fortunes.
Right, putting too many eggs in one basket.
Exactly. In these cases, it's prudent to systematically sell down that concentrated position over time to diversify, even if you believe in the company's future. Maggiulli advises doing this gradually, maybe selling 10% chunks based on predetermined rules, like time intervals or price targets, to remove emotion from the decision. The same logic applies to selling a losing investment to harvest a tax loss, or simply cut ties with a failed thesis.
And he makes an important point here about prioritizing needs versus wants.
Yes. He stresses the importance of funding the life you need before you risk it for the life you want. Meaning, if selling some of that concentrated stock allows you to pay off high-interest debt, fully fund your emergency fund, or secure your basic retirement needs, you should prioritize that security over holding on for potentially higher but riskier future gains. Remember, statistically, most individual stocks underperform the broad market over time, so reducing concentrated risk is usually the prudent move.
Secure the base first. Makes sense. And finally, the third and perhaps most obvious reason to sell.
The most obvious reason is simply meeting a financial need or goal, which is the whole purpose of investing. Why are you investing in the first place? It's usually to fund something in the future retirement, a down payment, college tuition, travel, starting a business, or simply having financial security and freedom.
Right. What's the point of accumulating all this wealth if you never actually use it to live the life you want?
Exactly. Sometimes you need to sell assets to use the money, whether it's funding your planned retirement withdrawals, making that big purchase you saved for, or establishing a safety net so you can pursue a passion project. He also touches on the concept of diminishing returns of wealth on happiness. Going from $0 to $1 million likely brings far more life improvement and happiness than going from $1 million to $2 million. At some point, it's okay to sell some assets and actually enjoy the results of your decades of saving and investing. That is the end game.
A great reminder that investing is a means to an end, not the end itself.
Okay, this leads us perfectly into a really fascinating and introspective chapter. Why you will never feel rich, and why you probably already are. This tackles the psychology of wealth perception. He starts with the really tragic story of Jack Whittaker, the lottery winner.
Yeah, it's a sobering story. Jack Whittaker won a massive Powerball jackpot in 2002, something like $113 million after taxes. An unimaginable fortune, but his life spiraled downwards afterwards, legal troubles, family tragedies, substance abuse, and he ultimately lost it all, dying estranged and reportedly broke.
Just heartbreaking. What's the key takeaway Maggiulli draws from this?
The most striking detail for Maggiulli was that Whittaker was apparently still playing the lottery regularly, even when his net worth was estimated at $17 million. It powerfully demonstrates that having immense wealth doesn't automatically guarantee feeling rich or secure. That feeling seems to be driven by something else.
And that something else seems to be relative comparisons. Exactly. It's all about relative wealth. Maggiulli recounts a story about his friend John, who received a $1,000 cash gift. John should have felt happy, but he actually felt kind of poor because his much wealthier friend, Mark, also received a $1,000 gift from his billionaire family. For Mark, $1,000 was pocket change, whereas for John, it was significant. The comparison changed John's perception.
We compare ourselves to those around us or those just above us.
Constantly. Maggiulli shares his own experience growing up. His family felt relatively rich during a local housing bubble when their house value soared, but then felt unrich when the bubble popped. Later in college, he realized he hadn't traveled Europe like many of his peers, making him feel less well off by comparison, even though his objective circumstances were far better than his childhood experiences. He mentions having roaches under the oven as a kid, which made even basic comfort feel rich back then. Our reference points shift.
And this continues even at the highest levels, right? Even billionaires don't always feel rich.
It's almost comical. He quotes the former CEO of Goldman Sachs, Lloyd Blankfein, who, despite being worth over $1 billion, claimed in an interview that he considers himself well-to-do, but not truly rich.
A billionaire doesn't feel rich. Who does he compare himself to?
Apparently, people like Jeff Bezos or Ray Dalio, who have tens or hundreds of billions. Objectively, Blankfein is in the top 0.01% of U.S. households, unimaginably wealthy by any sane standard. But because he can point to someone even wealthier, the feeling of richness remains elusive.
It's the everyone can point up logic, as Maggiulli calls it.
Precisely. Unless you are literally the single richest person on the entire planet, you can always find someone wealthier than you to compare yourself to. This dynamic creates a constant potential for feeling not quite rich enough regardless of your actual level of wealth.
So what's the trick or the perspective shift Maggiulli offers?
He simply reminds us not to forget all the people in the world who could be pointing up at you. Being rich is such a relative and subjective concept. It's incredibly easy to lose sight of our own objective well-being, our own progress, and the privileges we might have when we get caught up in making upward comparisons. Recognizing this relativity, and perhaps occasionally making downward comparisons or simply appreciating our own situation in absolute terms, can be key to actually feeling wealthier and more content.
That's a powerful perspective shift. Gratitude and appreciating your own journey. Okay, finally, we arrive at the last and perhaps most profound chapter, the most important asset, and why you'll never get any more of it. This brings it all back to something beyond money. He uses Peter Attia's thought experiment to kick things off.
Yeah, it's a brilliant thought experiment, Attia asks. Would you trade places with Warren Buffett right now, taking all his billions, but you also have to be his age, around 90? Conversely, would Buffett trade all his billions to be a broke but healthy 20-year-old again?
Most people would say no to the first and suspect Buffett might say yes to the second.
Exactly. Yeah. It intuitively highlights that for most of us, time, especially healthy time, youthful time is often worth far more than even immense amounts of money. Money can't buy back time.
And he shares the incredible story of Dashrath Manji, the mountain man.
An extraordinary true story from India. Manji's wife died because the nearest hospital was over 34 miles away around a large mountain. Consumed by grief and determination, he spent the next 22 years working mostly alone with only a basic hammer and chisel, carving a direct path through the mountain.
22 years with just hand tools.
Yes. He single-handedly shortened the journey from 34 miles to just 9 miles, connecting his village to essential services. He didn't have money to hire a crew or buy heavy equipment, but what he did have was time and incredible perseverance. He chose to spend his most valuable asset, his time, on this monumental task.
An unbelievable testament to the power of time and dedication. How does Maggiulli connect this back to personal finance and investing?
He shares a very personal reflection. He had set a financial goal for himself to reach $500,000 in net worth by age 30. Despite investing diligently during a strong bull market, he failed to reach that goal.
Why? What was his mistake?
His mistake, he realized in hindsight, was optimizing purely for money, not for time. His income, his ability to save, actually grew most rapidly in his late 20s and early 30s as his career progressed. But during that critical period, he wasn't focusing enough on maximizing those career opportunities, on growing his human capital faster, because he was perhaps overly fixated on his investment portfolio balance. He wasn't valuing his time and earning potential correctly during its peak growth phase.
So he was focused on optimizing the financial capital he had rather than optimizing the conversion of his most valuable asset, his time and skills, into more financial capital during his prime earning years.
Exactly. It leads to the core, unavoidable truth of the chapter. Though you can always earn more money, nothing can buy you more time. Time is the ultimate finite resource.
And this connects finally to the research on happiness across the lifespan, the U-curve.
Yes. Research consistently shows that happiness tends to follow a U-shaped curve throughout life. It's generally high when we're young, declines through our 30s and 40s, bottoms out around age 50, and then starts rising again through our later decades.
Why does that happen?
One theory Maggiulli highlights is that young people tend to overestimate their future life satisfaction. They have high expectations. As life happens, reality often doesn't quite match those lofty expectations, leading to a dip in happiness. But as we get older, we become more realistic, perhaps lowering our expectations, and we start experiencing pleasant surprises more often. We learn to appreciate things more. It's like we start life as growth stocks, with high, often unmet expectations, and we eventually mature into value stocks, where reality often pleasantly exceeds our more grounded expectations.
From growth stocks to value stocks, that's a really insightful, philosophical way to think about the arc of life and happiness, connecting it all back to expectations and appreciation. It really transcends just the financial numbers.
It does. It brings the focus back to how we use our most precious, non-renewable asset, time, to build not just financial wealth, but a life rich in meaning, connection, and fulfillment, understanding that our perception of that richness changes throughout our lives.
Wow, what a comprehensive and insightful journey through Nick Maggiulli's Just Keep Buying. We've covered so much ground, from the foundational philosophy and why consistency beats timing, to the practicalities of smarter saving, guilt-free spending, strategic investing in various assets, navigating volatility and crashes, and ultimately the deep psychology of wealth, luck, and the supreme value of time.
It really covers the full spectrum of personal finance, but with such a practical, data-driven, and often counterintuitive approach.
Definitely. Before we wrap up, let's quickly revisit some of the most impactful rules and mindsets we've discussed today, just to crystallize the key takeaways for everyone listening.
Absolutely. First, remember where to focus your energy. Prioritize saving when your portfolio is small. Saving is for the poor in relative terms. And shift focus towards optimizing investing when your portfolio is large. Investing is for the rich.
And critically, focus on growing your income, not just obsessively cutting tiny expenses. Income has a much higher ceiling.
Use the 2x rule for guilt-free spending. Match every splurge by investing or donating an equal amount. It removes guilt and adds intentionality.
When you get raises, aim to save at least 50% of the increase to keep your retirement goals on track while still enjoying some of your success.
Don't fear debt inherently. Understand how it can be used strategically, either to reduce risk, like a mortgage, or potentially generate a return greater than its cost, like well-considered student loans. But beware the psychological and health costs of high-interest consumer debt.
Remember the core purpose of investing: to replace your human capital with financial capital over time. Build assets that work for you when you eventually stop working. Think like an owner.
Buy income-producing assets. Diversify appropriately for you, and strongly consider low-cost index funds over trying to pick individual stocks, for both financial and existential reasons.
Invest now, don't wait. Time in the market beats timing the market. Get your money working as soon as possible.
Don't fear volatility. It's the price of admission for higher long-term returns. See market crashes not as disasters, but usually as buying opportunities, trusting the historical data over emotional panic.
And when it comes to using your wealth, prioritize funding the life you need before risking it for the life you merely want. Secure your base, but also remember it's okay to sell eventually to meet your goals. That's the whole point.
And finally, remember that feeling rich is relative and often elusive due to comparisons. Practice gratitude for your own progress.
Which brings us to the final, most important point. Wealth is just a tool, and time is your most precious, irreplaceable asset. So the final thought we want to leave you with today, something to really mull over, is this. What are you doing today, right now, to use both your money and your time wisely? Not just to build wealth on a spreadsheet, but to actively live a life that's truly aligned with your values, knowing that the real, lasting richness is often found beyond the balance sheet in how you choose to spend your finite time and energy. How are you prioritizing the creation of that most valuable asset of all, a well-lived life?
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button, subscribe for more summaries, and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.